Welcome to the Real Estate Way to Wealth and Freedom podcast with Jacob Ayers, providing actionable content to help you along your journey to financial freedom through real estate investing. As the premier asset class, real estate has helped ordinary people just like you amass fortunes. The benefits of passive income from real estate investing will allow you to live a life you want. And now your host, entrepreneur, real estate investor, and apartment deal syndicator, Jacob Ayers.
Welcome to the Real Estate Way to Wealth and Freedom podcast, episode 29. I'm your host, Jacob Ayers. Today our guest is none other than Keith Weinhold. Keith is a contributing writer to Robert Kiyosaki's Rich Dad Advisors blog. He's the author of 7 money myths that are killing your wealth potential. Keith has been a real estate investor for over 15 years, and today he runs GetRichEducation.com and is the host of the very popular podcast called Get Rich Education. Keith's mindset and investing philosophy can be summarized by the Robert Kiyosaki quote, "Don't live below your means, expand your means." He and his wife spend 9 to 10 months a year at their home in beautiful and pristine Anchorage, Alaska. They travel the other months. Today, I welcome on the show Keith. Keith, thanks for joining us.
Jacob, great to be here. Thanks for having me.
Oh, absolutely. Keith, it's our pleasure. So Keith, could you tell us a little bit about yourself and how you got started investing in real estate?
Yeah, I sure can. Well, my wife and I live in beautiful and pristine Anchorage, Alaska. And these days it doesn't matter where you live. You can live where you want to live and do virtually whatever you want to do. Real estate investing for me started out kind of differently than it did for some people. I would say, a couple years after I graduated from college and I moved from Pennsylvania to Alaska because I had vacationed here 4 times and I knew that Anchorage, Alaska is where I wanted to live. You work a job, you get a little bit of liquidity saved up, and it's kind of time for you to come of age and, buy your first home. It just sort of seems like societal inertia takes you there. But you know what, Jacob? I had 2 aspirational friends that I had met shortly after moving to Anchorage. And, it's sort of like the well-known quote, you are the average of the 5 people that you spend the most time with. And I would say 2 of my 5 were fairly aspirational friends. And what 2 of those 5 had done was bought a 4-plex building where they lived in 1 unit and rented out the other 3. So I had the confidence that I could do that too, but I didn't have a whole lot of money. But I took advantage of a program then that you, the listener, can still take advantage of today with a 3.5% down payment on an FHA loan, with virtually everyone qualifies for, living there 12 months and only having a minimum credit score of 580. I mean, mine was better, but that's all one needs. You can occupy 1 unit of a 4-plex building, live in 1 unit, and rent out the other 3. And I sure didn't understand everything about real estate investing then when I made that big purchase of an Anchorage, Alaska 4-plex building in 2002 for $295,000. And those lessons weren't always easy. You always have some tenant run-ins when you're an owner-occupant landlord. But I would soon start to realize numbers-wise what real estate was doing for me and how real estate is the number 1 wealth creation vehicle for ordinary people. It's that number 1 wealth creation vehicle of all time. So it all started for me kind of with a bang with a 4-plex building rather than buying and occupying a single-family home myself like most people do.
Yeah, that's fantastic, Keith. I couldn't think personally of a better way to get started investing in real estate rather than that low down payment that you're talking about and owner occupying a small multifamily property such as a 4-plex. So what a phenomenal investment vehicle for those looking to get started.
Yeah, it is. And, the numbers don't always work in the market that you're in. Generally the numbers work better in middle America than they do on the coasts. And, there are a lot of it depends factors on whether a 4-plex building might make sense for you to start off with. But it sure was a great thing for me, and it might be for you too.
Right. Very good point. So Keith, you mentioned you live where you want to live and invest where the numbers make sense. So you're investing a lot in the Midwest, but live in Anchorage, Alaska, where it's not necessarily a market that makes the most sense. One of your driving philosophies is this abundance mindset that you preach. Could you talk a little bit about that mindset and how that's got you to where you are today?
Yeah, well, most people have a scarcity mindset. Like I like to say, The scarcity mindset is abundant and the abundance mindset is scarce. So, really someone has a choice in sort of how they handle both their financial life and their life overall. And really one can either be conventional or one can be wealthy. It's not conventional to be wealthy. So if you want wealth, in order to create financial freedom for yourself, you really need to be unconventional. And I think my abundance mindset, it kind of revolves around a rich dad mantra of don't live below your means, expand your means. Why in the heck would you live a day below your means when you could just as well spend your finite resource of time figuring out how to expand your means? And maybe it's just best if I give some examples of a scarcity mindset versus an abundance mindset. Living below your means, which is a scarcity mindset, is maybe endlessly managing your own property throughout your entire real estate investing career. Well, you soon got to ask yourself, how big can I really get? How big can I really scale if I manage my own property? That's living below your means. Expanding your means is taking the time up front to vet a good property management company, hiring them, and then your scale is virtually infinite. Another example of living below your means versus expanding your means might be, let's just take a look at the way you might spend 30 minutes. Would you rather spend 30 minutes waiting in line for a free Chick-fil-A sandwich or spend those same 30 minutes maybe learning about how to increase your FICO credit score so that you can get the best mortgage rate, something that will benefit you for up to 30 years? Or you could spend 60 minutes mowing your grass when the neighbor kid wants to do it for $25, okay? So kind of metaphorically, you can sort of think of your life as, do you want to haul water buckets out to your garden every single day, or do you want to set up a sprinkler system one time? So that's sort of a metaphor within those more practical examples of scarcity versus abundance, living below your means versus expanding your means.
Yeah, really phenomenal. It can be counterintuitive to some people's thinking, Keith. So to really take this concept that you're preaching and let it soak in eventually makes sense, but at first it might seem a little strange or a little counterintuitive to how you live your life every day.
Yeah, it does, and you're totally right. It is counterintuitive, and if it definitely takes thinking differently, but that's what underscores a wealth mindset versus being conventional. So as we talk today, as we talk through some of these conventionally held mindsets and how one expands, you're going to see that it's not normal and it's not every day, but being wealthy is also not normal or every day. So one mindset, this expansionary mindset, is commensurate with wealth.
Right, Keith, and you're not new to this topic. In fact, you recently wrote a book called The 7 Money Myths That Are Killing Your Wealth Potential. And in that book, you detail 7 principles that people are getting wrong every day. So could you touch on a couple of those and, teach us a couple things from that book?
Yeah, I'd love to. I sure don't know if we can get to all 7, but I think the first myth in that book was don't live below your means, expand your means. And I give countless examples around that because it really begins with expanding that mindset. And that first thing, and it is unconventional, just like all of these are, is here's how much of society is sort of stratified, okay? We have a set of poor people, and they provide value to society, but, poor people, maybe they tend to be less educated, and they work for their money, and they really don't have any money left over. And then you have people that are somewhat better off. They tend to be better educated. Oftentimes, they're middle-class people. They work for money, too, but they have some money left over. And middle-class people often have their head down at a job. They're dealing with their family, and they don't really have that much time to think about investing. And what middle-class people have learned is, if I can just get my money to work for me, I don't know what could be better than that. What could be better than getting my money to work for me? So I'll just do that with my head down at my job, and I'll get some money working for me, like through my 401k plan that's going to be invested in stocks, bonds, mutual funds, and ETFs and such. But here's the abundant mindset shift, and this is not normal and it's not conventional, and that's just what you want. And this is a harsh truth for some people when they first hear it, but getting your money to work for you will never make you wealthy. It's not going to make you wealthy. What's the one wealthy thing above middle classdom that people do to create wealth? They get other people's money to work for them. Yeah, they get other people's money to work for them. And that's a mindset shift. That's a paradigm shift. And in fact, Jacob, some people, when they first hear that, that might give them pause. They're like, well wait, is that legal?
Right.
And even if that's legal, would that be ethical? Am I using people because I'm using their money? No. In fact, it's just the opposite. You can ethically use other people's money, and it gets better than that. You can ethically use other people's money 3 different ways at the same time.
How is that, Keith?
Yeah, so for example, it's what I do, and with what you talk about as well, Jacob. The ethical part is I provide housing for people that's clean, safe, affordable, and functional, so I can feel like I should be entitled to be a profiteer because I provide something of value to society. I'm doing good in the world. So how do you use other people's money 3 ways at the same time while providing good in the world with good housing? Well, really the 3 different ways are, number 1, when you originate a loan, for example, like I did with the fourplex building I talked about here at the beginning, I use the bank's money for leverage and to get the loan, and we're going to talk about that some more. So that's other people's money one way. The second way is I use the tenant's money so that on a monthly basis, the income meet or exceed all the building expenses. And then thirdly, I use the government's money for very generous tax incentives like tax depreciation and a mortgage interest deduction at scale when I buy a number of properties. So that's how I'm using other people's money 3 ways at the same time: the bank's money, the tenant's money, and the government's money. But most people just don't think about it that way. But that's exactly the genesis of how real estate investors really get ahead, using other people's money and doing it 3 ways at the same time.
Yeah, and therein lies the true power of real estate investing, right? And that is using other people's money.
Yeah, that's exactly it. But again, that's a mindset shift. That's not conventional. And you have the ability to go ahead and do this at scale. Now, part of that, and this kind of gets into the second myth, Jacob, as we kind of pivot from the get your money to work for you myth to the next myth, is that the first way you use other people's money is using the bank's money for a loan. Well, when you go ahead and originate a loan, that puts you in a position of a lot of debt. I have a lot of debt, okay?
Now that scares some people, right?
Right. That scares some people. And let's think about that. Why does that scare some people? Well, that scares people because people in the consumer credit world, they associate debt with something undesirable and something that they're trapped underneath. Debt, that sounds like, my car payment that I need to make every month, or a rent or a mortgage payment where, geez, I might need to work overtime so I don't fall behind on mortgage payments. So that's why debt is associated with drudgery or disdain or something that you really don't want to do, because most people associate that with consumer credit sort of debt. But when you go ahead and originate a loan on a property, you have the ability to outsource. That's a key word. You have the ability to outsource every bit of that debt to tenants. So a piece of the tenant labor works for you. I actually look to get more debt and look to get more leverage in my life. And I think really a good way, Jacob, to learn about this is through me just being very personal with an example here in how I avoid being debt-free and try to be financially free. And let's just define those terms before we go on, okay? So the myth that you think you want to be debt-free really is faulty. You really want to be financially free. Debt-free just means that you don't owe anyone anything. And financially free, that means you can do whatever you do whenever you want to do it. In fact, people's desire to try to be debt-free can actually prevent them from being financially free.
That's quite one another of those counterintuitive kind of ways of thinking, Keith. So
yeah, it really is one of those counterintuitive ways of thinking. So, the best way for me to personalize it is, okay, on my wife and I's primary residence, we have a mortgage balance of $405,000, $405K. That's how much we owe on our primary residence. Okay, that's a monthly payment of $2,700. About $2,000 of that's principal and interest, and the rest is taxes and insurance. Okay, now I have the ability to pay off my home. Effectively, it's sort of paid off on paper or paid off on my balance sheet, but I wouldn't want to pay it off in reality. I want to keep that $405,000 mortgage balance there and pay the minimum amount every month. Otherwise, I'd pay an opportunity cost, because this way I can have those dollars invested in other properties. So if I wanted to go ahead and retire my $405,000 mortgage balance to help become debt-free, I would take a step away from being financially free, because to retire that $405,000 mortgage balance, I would need to go sell apartment buildings and income properties, income single-family homes that generate $3,500 of monthly cash flow. I would have to sell $3,500 worth of monthly cash flow in properties to retire that $405,000 mortgage balance. But I just told you it only takes $2,000 a month, principal and interest. So I would be out $1,500 on a net basis if I tried to go ahead and retire my debt. And what would the other negative consequences be? Well, your housing payment really never goes away. It's only my principal and interest payment that would go away, so I wouldn't truly be debt-free anyway. I would still have a payment for taxes, insurance, utilities, maintenance, and repairs. Additionally, my portfolio size would contract because now I've lost income properties. So I would lose about $1.5 million worth of income properties that generally appreciate over time. I would lose that cash flow. I would lose the fact that those tenants are paying down the principal balance on those properties for me. I would lose the tax advantages associated with that. And I would also lose my inflation hedging benefit that I could get into later. So I would be out $1,500 of cash flow because I'm trying to retire debt and be debt-free. I'd be retiring the debt on all those income properties and retiring the debt on my home, but I'd take a step away from being financially free because I would be out cash flow and I would be out all the other benefits at the same time. So in summary, I don't want to be debt-free. I want to be financially free. So kind of in life and with this abundance mindset, I want to think less about reduction and more about production.
Wow, Keith, what a profound philosophy there. So you're saying by giving up the opportunity to use good debt and leverage other people's money, which will essentially expand your means, you are not going to sacrifice your good debt you have outstanding on your home.
Yeah, that is definitely a way to say it. So I would lose leverage, okay, all that leverage that I got from the bank. And leverage is really a powerful wealth creator. Leverage is something that makes ordinary people wealthy. And see, a tool like compound interest, that's something that middle-class people think is going to make them wealthy, but it's really leverage that you need for wealth creation. And again, that's unconventional leverage, but leverage is what leads to wealth. And that's really sort of the next myth. The myth is that you think compound interest will make you wealthy, but it's really leverage that's a wealth creator.
Yeah, right. So all of these philosophies you've been mentioning in these money myths are the fundamental basis of what makes real estate so powerful. You've mentioned in the past that real estate pays you in 5 separate ways, and we've touched on a couple of those. So could you dive into those 5 ways that real estate pays you?
Yeah, okay, because all this stuff might sound great, but this is an investing show that you have here, essentially, Jacob. So
Right.
Investing comes down to, okay, well, what's your ROI? What's your return on investment? So that's a great question that you asked because we can tie in a leverage example. So appreciation through leverage, as you touched on, Jacob, that's one of only 5 ways that real estate investors are paid. And most real estate investors, in fact, most real estate investing educators aren't even conscientious of the 5 ways that you're paid as a real estate investor. So why real estate makes others wealthy is that use of leverage. So let's say that someone wants to buy a $100,000 income property, a $100,000 single family home. And you can find these rehabilitated properties with a tenant that actually pays the rent in the Midwest and South, okay? Now, with a $100,000 property, you as an investor, since you're not planning to live there and you're getting a non-owner occupied loan, you typically have to put a 20% down payment on that property. So your skin in the game on this $100,000 property is $20K. So nationally and historically, real estate only appreciates at about 6% per year, right? That's not very thrilling. So after year 1, your $100K property goes up to $106K. Well, that's a $6,000 gain, but see, the difference is the $6,000 gain isn't divided by the $100,000 to calculate your ROI. Your $6,000 gain is divided by $20,000. You only have 20K of skin in the game. So now in this first of 5 ways that you're paid with real estate investing, you already have a 30% rate of return. Your 6K of skin in the game, your 6K gain divided by 20K of your skin in the game. 30%, how in the heck did that happen? Well, that happened.
We're not done, right?
Yeah, well, and we're not even done, right? That happened because you got a 6% return on both your 20K down payment, and see, here's the key. You also got that 6% return on the $80,000 that you borrowed from the bank. Okay, so the 80K of bank's money generated a 6% return for you. That money doesn't go to the bank, and that is leverage right there. Leverage is doing more with less. You're able to use the bank's money and your money to get a 30% rate of return through leverage appreciation. Secondly, let's just say this $100,000 property you bought in, we'll say Indianapolis, Indiana, which is where actually a market where you can find a lot of these properties. Let's just say you have a thin $150 monthly cash flow. That's $1,800 per year divided by your 20K of skin in the game. That's another 9% return on top of your 30% from leverage appreciation, so up to 39. Thirdly, you have a principal pay down not made by you, unlike your primary residence where you're making your principal pay down out of pocket. When you buy an income property and the monthly income exceeds the expenses, your tenant is paying down that principal for you. So that's typically another 5% return in year 1 of your income property at today's interest rate. So now we're at 30% plus 9% plus 5%. We're at 44%. The fourth way you're paid is through tax advantages, and that gets a little bit more complex, and it depends on your situation. So we'll just say that's another 2% tailwind on your return. And then finally, the fifth and final way that you're paid as a real estate investor is through something called an inflation hedging benefit, or really an inflation profiting benefit. And this fifth one is one that most don't understand. Just like you wouldn't want to have $1 million in the bank and keep it there for years because inflation erodes its purchasing power, you do want to have $1 million in debt, as long as those payments are outsourced to others, because inflation erodes the weight of that debt that you have to pay back in just the same way. And that's a point that a lot of people miss. The real rate of inflation is greater than what the government CPI is. So a 5% inflation rate or a 5% diminished purchasing power, that's another tailwind to you. So when you add up all those rates of return from number 1, the leverage appreciation, number 2, the cash flow, number 3, the loan pay down made by others, number 4, the tax benefits, and number 5, the inflation hedging benefit, that's a 51% total rate of return. And see, if you come from the consumer credit world, that just sounds almost irresponsible to say, or like you must be making a high-flying risk. But that's how real estate investors get ahead. That's not conventional and is wealthy.
Keith, how crazy is that? Now, after hearing all of that, I don't know how one could look at real estate investing and be skeptical or hesitant about its true benefits.
Yeah, you're right. My goodness. I mean, even if that 51% return, even if a lot of things went wrong and you just got a 30% rate of return, you're really beating a lot of investors handily. But I've calculated 51% there. And there are definitely some cautionary things to keep in mind. I think that would bring up the question in one's mind, well, what are the risks? Well, the risks are that you invest in the wrong market, and there sure are ways to hedge that and get around that. We sure talk about that on my show, Get Rich Education, an awful lot. There are other reasons why it could go wrong. And in fact, by year 2, your return will already be lower than 51% because you're probably going to have some equity build up in the property, and the return from home equity is absolutely zero. So that rate of return will get diluted over time, but it's still fantastic. And as you know, you'd rather have the high returns early on your dollar because that's how dollars can compound and grow faster.
Right, absolutely. Keith, we're talking about rates of returns here. And one metric that you like to look at is your return on time invested, going back to the abundance mentality. So could you talk about that return on time metric?
Yeah, absolutely. That's a really smart question, Jacob, because, us as investors, whether we're in the stock world or whether we're into putting a valuation on and buying a business or getting into IPOs or getting into real estate, we all kind of have these metrics we use. And especially as real estate investors, we've got some ones that are fairly unique to us. We have, we're thinking about our capitalization rate as we look on a Microsoft Excel spreadsheet. We might be thinking about our total rate of return, which I just brought up and calculated for you on real estate. We might be thinking about our cash on cash return or our internal rate of return. But really the most important rate of return in our investor lives is one that you'll never see on a Microsoft Excel spreadsheet. And that is, what is your return on time invested? Based on the amount of energy that you had to put into this and the amount of involvement that you needed to tie up in going ahead and generating this return, that's something that you need to consider. And it's a little bit nebulous. But the positive thing about your return on time invested is you get more experience in real estate. Your return on time invested typically goes up because your time invested as you learn these things, which is the denominator in the return divided by the time, your time involved with this goes down over time. I think you can also think about, instead of ROI as return on investment, think about it as return on involvement, okay? I don't manage any of my own properties. I know it's not my best and highest use. That's really a big mistake that a lot of investors make, is being a property manager for their own property longer than they should be. You got to think about how much time you're putting into this. If you get a property manager and they don't do a perfect job, because no one's going to do as good of a job as you, but don't get involved yourself just to get that last 3 or 4% of perfection. Once you've got a good property manager, that's how you make things scalable, and that's how you get a higher return on your time invested. Time is that one irreplaceable, irreplenishable resource. Once it's gone, you're not getting any more of it back, unlike money, whereas if you lose it, you can get it back. So the most important investor metric in your life is your return on time invested, the ROTI.
Certainly, Keith. And if you're measuring your ROTI, you're certain to succeed in this game. Now, you're preaching working on your business and not in your business, not managing your rental properties yourself, but rather paying somebody who's more equipped to do that for you. The same goes with a lot of tasks across the board, and whether you're going to take your time and invest it where it makes the most sense.
Yeah, that's right. And in calculating that rate of return, management fees are already calculated into that with our 9% cash flow number, or rather our 9% cash on cash return number, and coming up with that 51% total rate of return. So it's imperative before I even buy a property that I have sound management in that market. If I don't have sound management in a market, it doesn't really matter how good the property is. The property is not of value to me. So the quality of the team, especially the manager, which is the one that you're going to have the ongoing relationship with, that's more important than the property itself.
Right. Great, Keith. Well, Keith, as we're wrapping up today, we've gone over a few of these money myths and you've dispelled them. Now you'll dispel 7 different money myths in your book that's just released on Amazon. I've just read the book. It's a phenomenal read. It's very short, very digestible. So I know you've intentionally written it that way. Could you tell a little bit about that book and what readers can expect out of it?
Yeah, it's meant to not intimidate people and be approachable. I think a lot of people get intimidated with real estate. And, I think with the book, it definitely tells you a bit about the how, but it tells you more about the why. If you don't know your why for doing something, then why would you even wonder how you do that thing? So it really comes down to the why. And it really revolves around 7 money myths, a few of which we've talked about. One of them is millionaires have got it made. I tell you why millionaires are poor. A lot of it has to do with the fact that people think that home equity is a safe, smart, and sound investment. And I tell you why home equity is unsafe, illiquid, and the rate of return from equity, which is counterintuitive to people, is always 0. And really that your answer to financial freedom is investing with an abundant mindset. And, it's not grocery shopping for generics. It's not growing your own lettuce, okay? It's learning how to be unconventional and think like a wealthy person and make those actions that go ahead and reinforce that. And really what it does is it results in you, wanting you to make 20 to 25% down payments, smaller equity positions on low-cost income properties in 3 or 4 different geographic markets, and connecting you with those providers that have good management and good teams in those markets.
That's fantastic, Keith. So a lot of these things that we've discussed are paradigm shifting philosophies. So it might take the listener a little bit of time to maybe go back and redigest this stuff, but certainly great content. So as we're wrapping up here, we've got a lightning round and just a series of questions we'd like to ask you, and you just fire from the hip. How does that sound?
Yeah, let's go ahead. Let's do it.
Okay, great. All right, our first question is, what was your biggest hurdle getting started in real estate investing, and how did you overcome it?
Well, it was just that one word, fear of, and that was that fear of buying and operating a fourplex. I just really never saw myself in real estate or being a landlord. And the way I overcame that was surrounding myself with others. And that's a way that you can overcome obstacles and think bigger and think more abundantly too. The fastest way is to surround yourself with others that are more successful and follow what they're doing.
What a powerful piece of advice. Okay, if you were starting over with no education or capital, how would you get started in investing in real estate?
I would network. I would network with the right people and only put the smallest down payment possible on the best cash flowing property in the best market. You know, investing just for cash flow isn't enough. People think cash flow solves all problems, and cash flow does solve all problems today, but investing for cash flow isn't enough because you need to find and invest in that market where there's a durability to your income stream. So it's not about buying a property that cash flows today. It's about buying a property that cash flows today with a reasonable likelihood that there'll be another tenant in a positive job market coming in behind that first tenant when they leave to continue that cash flow stream for you. So it's not about cash flow today. It's about cash flow today and durability of an income stream. And you've got to remember that both the market, that economic market where those jobs are coming from, and that manager are more important than the property. So really don't start with a property. Start with relationships, learning markets, and finding your team.
Absolutely. Great advice, Keith. Keith, can you share a personal habit that contributes to your success?
Yeah, it's definitely, thinking abundantly, not living below the means, and instead expanding the means. So, you got to ask yourself as an investor or just in life, do you want your life to be more about reduction or more about production? So think about how you can produce, not reduce.
Great. Keith, can you share an internet resource that you find valuable?
I organize quite a bit of my life through the Evernote app. That's really handy. As a real estate investor and someone that's into business, we're doers. We're out there doing stuff. And doers, especially guys, it seems, they always have a list, okay? So on my Evernote app, I've always got lists of things to do. And you know what? That list will never be zero. And if it's zero, my business is probably dead, okay? So it's having lists organized on Evernote, and there will always be something more that can be done.
Yeah, and Keith, you may know this, but they also have another app that is linked with Evernote called Scannable, and you can take scans on your phone just by the camera and upload scans to your app there. So a really handy piece of equipment there.
Oh, that's good to know. I have a scanner app, but I don't think it's integrated with my Evernote, so I'll take a look at that. Thanks.
Yeah, absolutely. All right, Keith, what book would you recommend to the listeners and why?
Well, we're not going to bring up my book since you already did. Another good book out there that some people don't know about it's called What Every Real Estate Investor Needs to Know About Cash Flow, and that's written by Frank Gallinelli. It's a pretty numbers-heavy book, so I wouldn't suggest reading the whole thing in one day, but it really shows you where your return's coming from and how to evaluate an investment numbers-wise.
All right, great. All right, Keith, well, that wraps up our lightning round. Is there anything you'd like to wrap up with? Any parting piece of advice you'd like to leave with our audience?
Jacob, I think the one thing I would want to say is to be bold. Just 2 words, be bold. You know what? If you're looking to acquire wealth and you're looking to have more for your family and you do want this financial freedom and you value how being financially free is more important than being debt-free, it's to be bold and make action. People saw it as a bold thing when I moved from Pennsylvania to Alaska. People looked at me like I was trying to colonize the moon or something, but I knew that's what made me happy. When it was time for me to buy my first property, rather than getting a modest single-family home or a condo, I went big. I made sure that I knew how some numbers worked, and I had my gut to back me up that felt like the right thing because I was surrounding myself with the right people. So it was being bold by buying a fourplex. And then eventually, when I had enough passive income to quit my job, it was being bold enough to quit what was a very stable job that most people would find desirable and high paying. So these are some examples of how I was bold. And this is actually very good news for you, the listener, because you don't have to be the smartest person. You don't have to be the most articulate person. And you sure don't need to start off as a wealthy person. You don't have to have a lot of money in real estate. You just need to be bold. And if you're bold, that can take care of a lot of shortcomings. And the best way to be bold is to dispel fear. And the best way to do that is to educate yourself.
Awesome, Keith. Thanks for that. So wrapping up, Keith, where can our listeners find more about you or connect with you?
That's at GetRichEducation.com and the Get Rich Education podcast, where I crank out shows every week with a lot of the Rich Dad Advisors. I'm a writer for the Rich Dad Advisors myself, so we often have Robert Kiyosaki and his Rich Dad Advisors on the show, and it's still a little bit surreal for me as a young guy to be sort of writing articles right alongside them and having them on my show, but we do all that at Get Rich Education.
All right. Thanks, Keith. Well, we certainly appreciate you coming on the show today, and we look forward to next time.
Hey, thanks. Talking about this stuff energizes me, Jacob. I really appreciate appearing. Thanks so much.
All right. Thank you, Keith. Bye. All right. That wraps up our episode today with Keith Weinhold. I hope you're getting value out of the show. If you haven't yet, please go over and leave a rating and review on iTunes if you enjoyed it. Please subscribe to the show to be notified of new episodes. As always, if you have any questions or comments or want to hear something or someone specific on the show, let me know. Email me at info@jacobayers.com. Contact me at www.jacobayers.com or connect with me on Facebook at The Real Estate Way to Wealth and Freedom. Till next week, signing off, I'm your host, Jacob Ayers.
You've been listening to the Real Estate Way to Wealth and Freedom podcast, providing you actionable content to build your real estate empire. Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for personal advice. The opinions of guests are their own. Information is not guaranteed. All investment strategies have a potential for profit or loss. The host is operating on behalf of the Real Estate Way to Wealth and Freedom, LLC, exclusively.